Hi, this is Rachel Andujar, and this is FAR 1A, Conceptual Framework and Standard Setting for Business and Non-Business Entities, Part 1. And so we'll be starting with the conceptual framework, and that is going to be starting on page 1A-1. And we're going to go ahead and start at the top of the page, and we're just going to kick it off with a blueprint. So the blueprint says, recall the purpose and characteristics of the conceptual framework for business and non-business entities. So what this conceptual framework is it really is, what's the point? So what are we trying to show in these financial statements? And what this hierarchy shows is, okay, so what's the objective? What are the qualitative characteristics and elements? And then what are the underlying assumptions, accounting principles, and constraints with all of that information? So let's go ahead and start at the bottom of the triangle with the objective. So the objective of financial reporting is to provide information about the entity that is useful to present and to potential lenders or investors, so based on the needs of the users or stakeholders. So that's important. So you are making financial statements based on the needs of the users. So for example, if a lender wants to learn more about the company or an investor wants to invest in the company, they use this information to make accurate decisions. So that is the objective. Now, let's go ahead and talk about the second level, so the qualitative characteristics and elements. So qualitative characteristics involve both fundamental and enhancing, all right? So the fundamental characteristics are relevance or predictive and confirmatory value. So predictive and confirmatory are interrelated and can inform decisions for this year as well as help make decisions for next year. And so then there's also materiality and faithful representation, meaning you're showing accuracy to the best of your ability, and then neutrality and freedom from errors. And then enhancing qualities, that means consistency, verifiability, timeliness, and understandability. So then the elements that are involved are assets, liabilities, equity, owner investments, gains and losses, etc., that are in the financial statements. And just to clarify, that confirmatory value is feedback value. And then for materiality, that is, make sure you know this, that materiality is company specific and depends on the size of the company. So actually with each company in the beginning of an audit, for example, a materiality calculation will be completed. So that way you'll know what's your materiality threshold. So you'll know when you need to dig into something into more detail based on your materiality level. And you do that calculation with each company. So it is company specific. And then for faithful representation, that means it doesn't mean that every number is perfectly accurate, because you can't necessarily guarantee that, but that it's accurate to the best of your ability.